we had earlier used to have real estate as, an unorganized kind of sector, but with the RERA coming in, we started to see organization and proper regulation of the real estate sector. So now, together with, looking at the regulation, what one needs to care of is, wherever there is a project, there has to be some planning and there has to be some idea as to how that project is going to be financed. That is one of the first decisions and one of the first considerations a builder, or rather someone who's known as a promoter of a real estate project under RERA, would have to take. So in order to deal with this topic of, how are real estate projects financed, what are the sources, and what can be lawyers roles, okay, in this specific area, we have with us Sadhav Mishra. Welcome, Sadhav. And he, yeah, I think we'll need to unmute you.
Yeah, thank you.
Yeah. Sadhav, I think the volume needs to be increased a little bit on your end.
Is it okay now?
Yeah, that's much better. Thank you so much. Okay, so Sadhav heads the real estate practice of SNG and Partners. He has a rich experience of 15 years in hardcore area relating to real estate. He's advised quite a few builders, developers on different kinds of transactions, agreements, and he has also, prior to that, he also worked with, a large real estate company. So he has an amazing depth of experiences, particularly as far as, projects in Maharashtra are concerned. So welcome, Sadhav.
Thank you, Komal. Thanks for the introduction.
Yeah.
I think the people are really, really anxious and sort of excited to kind of know what we are going to talk about today.
Yeah,
So
because it
without,
looks like a financing topic, but we are going to approach
yeah,
it this way.
yeah. So though it looks like financing, and we will try to probably see touch base on the finance part of it also, but it primarily will focus on the legal side of how the funding is done, and broadly we'll try and cover the Maharashtra part, because as we know that real estate is something which is very, very diversified and very, very specific state wise. So since I'm based out of Maharashtra, so I will obviously give you examples of real estate projects related to sorry, Maharashtra. So so basically, without taking much of your time, I'll straight away start the the presentation on the project financing in the real estate. So when we say that project financing, I will just one second, Kumal. I'll try to kind of share the screen.
Sure, sure.
I think host, it's showing host disabled participant screen sharing. So
I'll change that settings. That is okay.
okay, yeah,
Yeah, I think you should be able to share it.
yeah, sure. So basically, what is this sound making? So it's very important for us to understand when we say project financing in real estate. So I believe that we need to understand as to what is a real estate project is. As Komal mentioned, that the last 2 3 years. Real estate has seen a substantial change in the way it was functioning before, because a lot of regulations coming in. So this probably one of the most unorganized sector, which probably is one of the biggest contributor to GDP, and now is gradually being organized, and it's being streamlined now. So with the advent of RERA, in the year 2016, which is like 4 years back, the developers started feeling hate of it, because I mean, we human beings are such that we generally do not like any kind of change from our regular pattern. Now this is and that's exactly what happened to the real estate industry also, which was kind of which had its own very unusual way of functioning over many decades, has suddenly seen a change, and the change was pretty welcome, which with the advent of RERA, then subsequently you had all those GST coming in, then IBC coming in. So many regulations have subsequently come, one after another to kind of further regulate the industry, more in a more transparent way, and in a more legal and sort of systematic way. So if you see the RERA defines a real estate project as a project which is basically for the development of a building or buildings consisting of apartments, or converting an existing building or a part thereof into apartments, or the development of land into plots or apartments, as the case may be, for the purpose of selling all or some of the said apartment or plots or buildings, as the case may be, and includes the common areas, the development work, all improvements and structures thereon, and all the easement right and appurtenant belonging thereto. So typically, real estate project is something which means all kind of construction which is related to the real estate, which is related to construction of building, which is related to construction or reconstruction of building. When I'm saying construction or reconstruction, that means a project which is already I mean with a land which is a vacant land. There you construct a building. That's a kind of project. Or probably a plot of land which already has a structure, you demolish it and then you construct an apartment. So all those kind of basically projects are called as real estate project. Now when we say financing in the real estate project, so basically what we are talking about here is basically when you kind of go for a development of a project in a real estate, typically because of the magnanimity of the project and the cost involved of various kind of approvals or probably land acquisition, it's so exorbitant that it's almost next to impossible for anybody to arrange money on their own, from their own source, and do the construction, which is very, I mean, it's next to impossible. So that is where the need to raise money comes for a real estate project. So when we say that basically if a developer has to go ahead and kind of buy a land, and then to do a construction on the land, so probably he may have the money to buy the land, and but he may not be having to go ahead and further do the construction. That's where financing is required, that's where funding is required, and that is what you call as project financing to a real estate project basically. Now, this is a bit of technical and legal both. So typically, what happens? A developer in need of money approaches probably an entity or a investor. Now, investor will deal with the investor in the the succeeding slide, in the next slide. So here, what I wanted to kind of highlight very briefly and very shortly is that if a developer has to go to any lender, which could be a private equity player, which could be a NBFC, which could be a fund, which could be a bank, or probably HNIs, nobody, straight away gives the money. Even if your project is fantastic, suppose I'm a developer and I have a, sort of gold mine right in the middle, right in the heart of the city, and I want to kind of develop it. So just thinking that I've got a good asset and I want to go and get the funding done, so it's not that easy. That so what I'm trying to say here is that even if you hold a very good project, a very good asset which you want to develop, basis simply on the basis of the project, you will not get money easily. There are certain procedure, there are certain sort of parameters which has to be fulfilled, which has to be complied with by the developer, by the company who wants to borrow the money, and that has to be really looked into. So if you see the first process that is generally followed by any of the lender, it could be NBFC, private equity player, banks, funds. They first of all they will see the credit history of the entity that is going to borrow the money. They will want to know that how many projects you have delivered, because and the reason I'll tell you why, because it's not question of just giving money and sort of relaxing. It's about like when you are giving money, it's like if I have to give you an example, it's like you I suppose I come to you asking for 100 rupees, and you know that this man is not worth even 1 rupee. So then you will really don't know that whether your 100 rupees is going to go come back to you or not. So it's very important to check the the sort of history, the credit worthiness, the of the entity who is going to borrow the money, the kind of deliverables which he has done in past in terms of project that he has delivered, in terms of a project which is currently undertaken to kind of complete, and how strategically he is positioned in the market, you know which is what we talk about, probably the goodwill of the entity, of the person, of the individual, of the promoters. That is equally important to kind of looked into. The third point which I have mentioned here is the company profile, the management capability and quality. Now it becomes very very important for an investor to kind of understand as to what is the profile of the company vis-a-vis the project that is being offered, or that is being considered for the purpose of funding. I would probably give you an example to further elaborate on this. Now in Bombay, if you, I mean, we all know that there are a lot of top players like Rahejas, Lodas, and all of them. You know, so suppose Rahejas, who are like top-notch developer in Bombay. Now, if there's a slum project which they want to kind of which they have gotten into, unfortunately, and they want to kind of go for funding for that particular project. Now, that group probably may not have expertise on the slum projects, on the delivery of the project, which are slum projects. So there the capability of the borrowing entity cannot be questioned, but the capability vis-a-vis the project is something which is very very probably, if it's a slum project, then there are players in the market who have got better expertise to do slum projects than the developer who doesn't have those kind of expertise. So that equally becomes very very important from the perspective of the credit analysis when you do for a project for the purpose of lending a project. And the next point is project evaluation and cash flow. Now, cash flow is something which is very important because the market fluctuation, it becomes very important, and the reason being, real estate market is something which is like it sees like up and down in no time. Today the prices may be X, and then after a year it will be like Y, and after 2 years it could be minus X. So and the project cycle is generally, when a project is being funded, the project cycle is generally 3 to 4 years. So on day one, when you are probably seeing the project at X value, may not fetch you the same value. It may be like 2 times of X, or it may be lesser than that. So from that perspective, it becomes very very important to kind of understand as to what is the cash flow of the project, so that accordingly you can, I mean, as a lender can see that how much money is to be sort of given to the borrowing entity, so that you always keep that margin, the margin of that fluctuation, which I was talking about. And then the next point is the technical parameters, the development model. So basically, what happens, the technical parameters when I'm saying, so it's basically viability of the project. When a project is to be funded, the viability of the project is to be seen. That's very important to be seen, in the sense. whether the project is technically capable of being implemented and constructed. So those are basically points which ideally has to be seen before.
So what is technical? Like, is this like structural elements or
So
how?
I'll tell you. Yeah, exactly. So basically, now suppose if there's a project, which has say the potential of say 1000 FSI, so then you calculate your valuation accordingly. You take your cash flows out accordingly. But then the technically, if the project cannot be constructed beyond 400 square meter, probably because of the height restriction or something, then that the project is not viable only. So though the what you call the FSI component is there, but then technically it becomes non-viable. So then it becomes a non-starter, because then your valuation of the project gets reduced accordingly substantially. So that is what exactly it means, the technical parameters that has to be seen. Now these are something which has to be kind of worked upon by a investor in length and way in detail, because I could just lay hands on the basis of how the credit analysis is done. Once all those things are like in place, once all those things are like a good to go kind of, then the commercials are discussed with the between basically the investor and the borrowing entity, you know and once they agree on a particular number and the interest, etc., etc., then an offer is given by the investor to the borrowing entity. That is in the form of a sanction letter or offer letter, basically, which basically talks about everything related to the project, which talks about what is going to be the money that is going to be given to the to the borrowing entity, what is going to be the ROI, what is going to be the moratorium, what is going to be the securities, what all other securities are taken, if there's any guarantee that has to be taken, all those things will be talked about under the sanction letter. What all are the security documents that has to be executed, the modality of repayment of loan, all those things, so that's the second step after the first step, which is the credit analysis. That is, I think, very very lengthy, and this is something which is a job of a business team, of the investor company. The investment banking team will do all those credit analysis. Once that is done, the sanction is given. Now once the sanction letter comes, that's where probably as a lawyer we all need to kind of look into it as to how to kind of then go ahead and structure the deal. So typically every sanction will be backed by some security, and the security in a real estate project financing will typically be the project itself. The project itself becomes your security. And so that's where it becomes very important to kind of have a very very clear cut understanding of the title of the project, so that your mortgage is always a good mortgage and unquestionable mortgage. And the second part is obviously, as part of the sanction letter, you do the evaluation, and the technical opinion is also done by the basically what do you call the lending entity. They do all of it, and once everything is in place, then the security is created and money is advanced. Now moving on to the next slide. So what I discussed in the earlier slide was basically a brief process of how a project finance is done. Now project finance is done once the credit analysis gets over, then a sanction is given to the entity, and then accordingly the next step is like, as per the sanction terms, whatever documents need to be executed, drafted, etc., is done. And then the project, and then the process starts. Then basically, the process of advancing money, and then construction, everything starts. Now, moving on to the next slide, funding options through a project life cycle. Now, it is very, very important for us to understand that a developer can have funding at any of these stages and at all the stages of the project. When I'm saying the first stage is land stage, when you see Now, real estate project finance is something which is very very interesting, at the same time very very peculiar also, because when you are saying real estate project finance, it could be financing of the land also, the acquisition of the land, because the land value sometimes is huge, and a developer cannot get money from his own source, and that's where they need money to fund them at the at the acquisition stage itself. you know Forget about he owning the land and then getting money for construction and all. Many a times the developer, they need funding at the acquisition stage itself. So what happens in those cases? Lot of in the market, when you go, you see that there are a lot of banks. Most of the banks, Indian banks, will not do any kind of funding, land funding. So the developer, the option that is available.
Is there, sorry, Sadhav, is there a restriction on the banks that they can't
Yes,
actually fund?
yes,
There's a
yes,
restriction, they can't
yeah,
fund land
yeah, yeah,
acquisition, right?
yeah.
So only NBFCs do it, I think.
NBFCs do it, but that also at land, especially in this scenario, it's I mean, it's a choice, but they don't want to get into it. They don't want to get into it probably because when you are going to acquire land at that point in time, it's very very, I mean, it's a big risk which you are taking, getting into the project at that point in time when you are going to kind of acquire land, because you really don't know how the project is going to shape up, whether it's going to come up also or not. And that's typically, that's where your equity players comes into play, because they always play on big margin, big profit kind of game. So that's where, if you see, a lot of fundings happen at equity level will be at land acquisition stage level only. you know because once you acquire the land, then the equity holders, they probably they want to get an exit after you get the construction loan availed, and then they try to kind of move out. So that's where they I mean, because the risk is more, so they can demand more on the sort of investment. So that's one stage where where generally what we have seen, that a lot of equity investment, lot of equity financing is done at that stage, uh, which is exactly the case. Land stage and early project stage is more or less the same. When you land stage and early project stage is like when you have tied up to acquire the land, and then finally you acquire the land. you know then the third stage is construction stage. Now that's typically where your lot of banks and lot of NBFCs come into play. They try to kind of their hand on at this stage where the constructions are in place and the project is good to go. So the risk factor is comparatively less here, because the land is already there, the approvals are in place. Only thing is that the guy needs money to kind of do the construction, and that's where the banks and the sort of NBFC and all those players from the market, they come together, and they kind of fund the project. So this kind of funding is generally typical vanilla debt transactions, wherein you pay 100 rupees, against 100 rupees you take project as a security. You take maybe personal guarantees of the company. You create charge on the receivables of the project. Those are your securities, and as and when the project is getting sold off, you are getting your money back, and then you are exiting from the project at X interest, whatever interest rate is agreed upon. So that's the second stage, construction stage, where you will see a lot of transaction happening, a lot of project funding happening, wherein all the banks, all the funds, and everybody is like there to help any developer out for a particular project. The third is like late project stage and completed project stage. Now, uh, sometimes it does happen that the project, the developer has got money. He kind of somehow maneuvered and got the funding. Maybe those funding may not be anywhere. It could be an individual HNI's funding, or their kin and kith funding them in the project. So they have gone ahead and started construction, but up to a particular point they could do it, and then they are like okay, they never envisage that okay, there could come a situation wherein they won't be able to kind of complete the project. So that stage is something where they go for the what you call funding. And for any kind of investor, be it NBFC's bank or HNIs and all, this kind of funding is very very lucrative, because there is nothing as such which can stall the project. For them, it's something which is good to go, the project. And the only thing is that the guy doesn't have money. So as an investor, you want to squeeze as much as you can. So basically, late project funding and completed project funding is something which is not seen generally, because you will hardly find any player in the market who will, from his own source, who will be in a position to kind of complete a construction up to a substantial percentage. So, but then having said that, there are cases wherein you will see late project funding or completed project funding stage, or the next one, surplus liquidity stage. So these all are basically done to kind of so I'll when I'll talk about the various instruments of funding, there I will basically link it to surplus liquidity funding and completed project stage, because what happens, the construction stage funding you have taken, I mean, if I can give you just an example, the construction stage funding is done. Okay, now the project is coming up. Unfortunately, there is no sale, or the sale is not to the extent what was expected. So the developer is definitely, in that case, will have liquidity crunch, but he has to serve the interest. He has to kind of go ahead with the construction because of the RERA timelines, etc. But he doesn't have money to kind of basically to put in again. So what he does in those cases, he goes for bulk inventory funding. So he will take a top up loan from someone else, and kind of ready to move in kind of stock he will trade. He will sort of take money against that, and that he will get it released from the from the lender one who has funded at the construction stage, and he will repay to that guy to the extent of that inventory which is given to some other entity, as bulk inventory funding. So from that perspective, it becomes important. If the project is coming up and unfortunately there is no sale in the project, in those kind of cases you will see this kind of funding being done. So now coming onto the project financing, the modes of project financing. So what all are the ways to fund a project? So if you see, the one of the, as we very briefly discussed, one of the very sort of prevalent and very very popular instrument that is there, that is debt. That is generally used at the construction stage level. Debt is something which is a loan, which is in the form of a loan, which is either taken by the bank, or maybe it can be taken by HNIs also, or some syndicates. So uh, the most important thing for a debt is to basically to differentiate it with equity, is basically debt is something which is capped when I am saying. So basically the what it means is your profit is capped, your risk is capped. So basically it's a very very sort of safe kind of bet. And that is why you'll see a lot of banks and funds and everybody going for debt funding, wherein the approvals are in place, so that they feel that, okay, demand is there in the market, I've got the approval, project is going to definitely the project is going to be sold. If the brand is good, then typically my money is secured, and the interest which I am getting is going to be my profit. So it's a very very safe kind of bet for any kind of investor to play in the real estate market. Contrary to this,
I have a question here which is there on YouTube, and it's relevant here when you mentioned that it's a safe kind of bet, because people are, the question directly is on the security. So it's like when you don't have the construction that's yet come up, then what is the uh, extent of security that you actually get? Because this is an under construction project there, the property hasn't come up yet, it hasn't come into existence. So, how do you consider that as a really relevant security when it comes to debt finance?
No, so I'll tell you, Komal, this I have taken another slide which is talking about, there's a separate slide on mortgage and security. Maybe you want me
Sure,
to
sure.
take
We
it up
can deal with
there.
that.
Yeah, so when
Yeah,
we'll
yeah, we
go
can
on
deal
that
with that.
security, we'll answer this question
Yeah,
that what could be the security when the approvals are not in place.
yeah. Another question here is it possible for individuals to lend money to real estate? Like, right, how you said HNIs, usually they will go through the equity mode. Can they actually also provide debt? And then do they need something,
They
some kind
can.
of
So
a
it,
license?
yeah. So no. So basically, unless you are in lending business, in just one of the kind, like suppose if you are
Exactly,
into
yeah.
construction, if I want to kind of give money to you, I don't need a banking license, but I can, as an individual, I can give you, I can lend money to you. It will be a loan to you against which you can always, give me some kind of assurance, which will be a security to me. So that at individual level can be done, and that is something which is happening also. But unless I am into business of lending and financing, then yes, I mean obviously you need to have the banking license and all those stuff. Now the second instrument which is for the project financing, that is called as the debentures. You know, now that debentures, when we are talking about, so it's basically it's again a financial instrument, and this is done through a public issues. Um, Dates are basically debentures are of two kinds. NCDs, basically one is convertible, one non-convertible debentures. The basically difference between a date and a debenture is, the debt instrument is basically will have your I mean you'll have your security there, you'll have your loan agreements in place, unlike debenture wherein you will have a fixed tenure, and the basically investors who will invest in your debenture, they will have a sort of regular returns basis the understanding. Now, the debentures, when I am saying,
As I think you can also approach a wider range of audience in case of debentures. So maybe the stake for one particular person can be a bit lower than how you are in case of debt, like which will be huge stake for one entity or one person who's lending.
correct, you are right there. Yeah. Yeah, correct. So moving on to that debenture, there are two kinds of NCDs basically, secured and unsecured. When you say secured, so this is like, the secured are considered wherein you take a security also of the asset basically. So in those kind of secured NCDs, there what will happen basically, the investors will have a recourse under law to recover their dues by liquidating the security which they have taken, which is not the case, in case of unsecured NCDs. Now, in the case, since the NCDs which are unsecured, there the risk is high, so obviously the return is high. The interest component, that is what is the market basically. That is where, so basically a degree lower than private equity, higher than the debt, is your unsecured NCDs. And secured NCDs is more or less like, at more or less at debt level only. You play, whereas in unsecured NCD, a little below than private equity players, then the who basically invest in the company, who takes equity in the company by putting in money. So unsecured NCDs also have a good return on asset in terms of investment, because there you are playing completely on the debentures of the company, and not on the security which is backed by the debenture basically. So we've spoken about debt. We have spoken about debenture. The third kind of basically fund that is available in the market for a real estate project funding, it's an equity. So when we say equity, we all know that equity is basically very high risk capital. In the sense that its downside is something which we don't know. If the company goes bust, if the project goes for a toss, then money is gone. But if the project is sort of like turns out to be a gold mine, then the upside is like, since you are an equity investor, it's uncapped. So on pro rata basis of your shareholding, you have the, you have the money with you, so basically this is high risk high return game, you know and this typically, what happens now, you see from a developer's perspective, if I'm a developer and if I've got approvals and everything in place, I would not want anybody to, take charge of my company, because generally the equity player, if you'll see, the equity player will want to have control over the company itself. They will want to run the company, literally, I mean in literal sense, because they will take control of everything in the company, which as a developer, if you ask me, if I have acquired the land and if I've got all the approvals, I at this stage I will not want, sort of anybody to come in and take charge of my, my company. So, and knowing the fact that at this stage I can go and get a, sort of, better rate, I can go and explore wider options. So so in those cases, what happens, the equity is something which is not that great, and a prevalent kind of funding that is available in the market. Yes, having said that, if a guy who is into the construction business, not very old, for him probably raising a construction finance may be a challenge, because of the credit analysis of the entity may not be that great. So those kind of cases, you will see a lot of private equity player coming in and getting into the property. There they purely see the project, and that's where they get into the project. So when I am saying equity, basically, so if you see, there are basically two, three kinds of equity that are generally infused in a project. For a small time project, the money that comes from, friends and family, they buy the shares. They basically, invest in shares, and then that's how the money is pumped in, and they become your shareholders. Crowdfunding is something, which is also prevalent, but not very prevalent here. Here in India, generally you will see either friend and family office, or institutional money. This is something which is generally, prevalent in our Indian market, depending on which category of developer you are in. If you are a sort of small time developer doing a project in a specific area, so there generally you will borrow money from friends and family, or maybe, from your family offices, and you will kind of, do a construction of say 20-story project, and then you will take another project, again you will do raise money accordingly, and then you will do it. So that's one way of doing it. Another is institutional money, where the value, where the volume is really really big, and where you want to play a sort of a big game. So there your private equity players comes into play, and that's where, the equity funding is done. So, as I mentioned in the beginning, different types of funding are used at each stage of life cycle of a real estate project. Like a company may use equity to finance the sourcing of the deal. So, which is what is the land, funding, which is what we were talking about, the early stage of the project. This is because there's a high risk in early stage of a project, and since the risk is high, so probably, the safe players in the market, like the banks and the, NBFCs, they may not want to look at this kind of funding. So that's where the basically the players, the real estate players, are left with no option but to go to sort of equity players, and that's where the real transactions in terms of equity funding is generally done. Now the next kind of finance which is available in the market, that is structured and mezzanine finance. So structured or mezzanine finance, when we say, so this is basically, it's a mixture of debt and equity both. So what happens, like, initially at the time of acquisition, you have taken equity. Later on, got debt into the project without giving exit to equity players. You know, so that's the structure which has to be kind of structured in the beginning of the project itself. But that is also something which is very very prevalent in the market. Having a mezzanine kind of finance, which is the combination of debt and equity both. Now, the next sort of next kind of funding that is possible and that also happens, is basically joint venture or joint development. So 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 when I said equity funding at family, from family, friends, family offices, friends and HNIs and all those kind of funding. So joint venture and joint development is also more or less like that only. I am having a land parcel with me. I am a developer. I want to develop it. What will I do? Either I will come to probably you, ask you to put in money in the project. You may not be interested because probably you have no trust in the company, you have no trust in me, so you won't want to drive it yourself. And my interest is could be two way. My interest could be either I want to kind of have my own branding, or I just want to make money out of it. Depending on that, I can have some kind of arrangement with the other person, which could be in the form of joint venture, which could be in the form of joint development, wherein the other person will invest money, you know and depending on, like, the commercial understanding, he can do construction or I can do construction, and I can take my share out, which will be probably my cost of land and my return on land. So those kind of structures are also there, which is kind of common in the market and which is happening. uh, the next is
So
basically,
just
yeah,
one
sure.
one thing in joint development, um, you kind of pay the landowner where you are acquiring the land. You kind of pay the landowner with something that may be a future payment, like
Possible,
let's say
yes.
some
No?
units in construction or
Yes,
some percentage
yes,
of the profit or
yes, yes, possible. It's purely commercial. I mean, depends, like, on day one. If again, I mean, everything will boil down to the commercial. Now on day one, suppose if I'm the landowner and I'm getting into a JDA with you, okay, but I want kind of money. So on day one, you are basically also sharing the risk of a project being successful or not. You are sharing that risk with me, but I want an exit on day one only, without seeing the kind of risk the project may encounter, or probably the kind of fruit it may reap for us. So in that case, my take or my exit will be basis of the risk only. So if I do not want to take risk, then my exit will not yield me that kind of result in terms of monetary compensation if I'm taking. But if I am ready to take kind of the go with the project and take my area, so probably that will be a so again, I mean, as said, that this is purely commercial, which has to be kind of seen, and both the parties will obviously assess that commercial viability, and that's how. So however, there is no restriction. It could be either monetary compensation or otherwise also. Now, the third is bulk inventory sale. Now this is exactly what I was talking about, that the completed when the project is as completed stage, or nearly completion. So there what happens, lot of you will see in the market, obviously I can't name it, but on no name basis, I mean, I can probably for academic purpose I can say that a project that is almost nearly completion, and unfortunately if there is no sale in the project, then a lender who has given money to for the that particular project, they themselves come forward, and through their other entity, they kind of do a trade off with this inventory purchase. So they fund against the inventory which is already ready. So that what happens, that the account doesn't get NPA, and the money is repaid to the lender, and the developer is in safe hand. That's another way of funding which is generally done. This is very, very typical to real estate projects only, wherein you will have double, I mean, where you will have funding two times on the same project by the same entity, just to kind of so it's a basically, you can say that it's a bridge funding, because the moment you find out a buyer, the money is repaid. So till the time you get the buyer, this funding is done by the some other arm of the of the investor, and so as to avoid the account being NPA. And the third is not third. I think probably this is the fourth or fifth kind of funding. So which is ECB, external commercial borrowing. I think we all know that basically these are the loans which are made available in India by the by the non-resident lenders, which is in the form of foreign currency to the Indian borrowing entity, and that's how the money comes in. So this is generally, I think, with the recent guidelines and recent norms which has been wherein the ECB has been allowed for affordable housing, you know. So this has become probably one of the very flavor of the kind of of the industry as far as borrowing is concerned for the affordable housing, you know. So this is another way of funding that is available in the market.
Only that is permitted use of the ECB and not the other purposes, right?
Yes,
So
yes,
real estate is restricted, I think, as far as
correct.
ECB is concerned.
Correct. But then I think affordable housing, some relaxation has been given to the affordable housing segment of the real estate. Otherwise, it's not allowed. Yeah. Now, see, basically, now here I have briefly mentioned the legal instruments in a project finance. Basically, so we spoke about what is real estate project. We spoke about what is the process, how the process is followed for funding of a real estate project. First, there has to be credit analysis. Then there has to be once that everything, all checks and balances are in place, then the funding is done in terms of a sanction letter being issued by the by the investor, and then basis sanction letter everything follows. So when I said basic sanction basis sanction letter everything follows, now this is exactly what follows on the basis of the sanction letter, because the sanction letter will talk about various securities. The sanction letter will talk about facility being debt, facility being debenture, facility being could be like uh, equity, whatever it is. So on that basis only, the documents are drafted. So as a lawyer, if I have to kind of summarize and categorize, so for a debt transaction, pure debt vanilla transaction, the documents that are generally executed are mortgage deed, then the hypothecation deed. Now these are the two documents which are basically the security documents. Security documents wherein the security over the asset is controlled or probably charged by virtue of these documents. There will be a loan document. The loan document will talk about it's going to be a bible of the entire facility that is advanced to the borrowing entity. That is what your loan agreement is. It will talk about all the checks and balances, all the terms of the loan, all the understanding, all the refs and warranties, all the securities, everything, repayment and trigger point, if there's any event of default, what will happen, all those things will be spelled out completely in length in the loan agreement. Depending on case, on the project basis, some of the lenders, they do go for personal guarantee, they do take corporate guarantees. That's another kind of security which is generally taken by the lenders, for a day transaction. You see NCD transaction, so in your NCD transaction there will not be any kind of mortgage as such. There will not be any kind of hypothecation as such. There will be a debenture document, which will be a debenture trust deed. The trust deed itself will talk about the modalities, how debenture are going to be subscribed, and at what is going to be the interest, and how the takeout will be. And the debenture will be coupled with security on the immovable asset also. As I said, that secure debenture, if there is a secure debenture, then your debenture itself will talk about mortgage of the asset. And if it is unsecured, then accordingly the drafting has to be done. Buying that loan agreement is something which is going to be common for debt, debenture, equity, everything, because loan is something which is sort of byproduct of sanction letter. So you have the sanction letter, but to give it a legal form, there has to be a loan agreement, which is which is an absolute valid and legal document.
Will
So
there be a loan agreement for equity financing also? Like how can, because you're putting equity
no,
into it.
no
So
equity, yeah, equity financing. I think loan agreement. No, I think this is some.
So when
equity
you're
transaction,
taking equity
correct.
as a security, I probably that's what you mean, right?
Yeah.
Because you said
But
PF
otherwise,
pledge.
otherwise loan agreement will not be there for equity transaction. Yes. It will be a pure understanding, which will be an offer letter kind of or sanction letter. Offer letter, generally we call it, and then basis which the your shareholders agreement will be accordingly sort of formulated and drafted, and the shares and all everything gets placed in accordingly. So basically these are the security instruments for a project finance that is done either by debt, equity, or debentures. This is the next step. The next step is basically I have just tried sort of splitting the whole process of project financing. Initially, the first thing what we discussed was credit analysis, then sanction, then the types of instrument, the which a borrower or which a developer can go for in the market for the purpose of funding, and then the security documents that are executed. Now this is enforceability of the document. This is more from a lender's perspective. This is more from an investor perspective, because the developer will be very very happy if the documents, if the legal documents are not properly executed and not properly done, so that enforcement he can get away with the risk of getting enforcement properly done. But then as a lawyer, if you are representing an investor, then it's very important for you to understand that all your security document has to be duly stamped. Now there are different articles dealing with different kind of stamp duty payable on different instruments. If you have a loan agreement, if you have a guarantee, if you have a hypothecation, if you have a mortgage, then under Bombay Stamp Act, the stamp duty that is supposed to be paid is all prescribed under the Bombay Stamp Act in schedule and different articles of the uh, of the act. So as investors lawyer, it's important for us to kind of see that documents are properly stamped, which is adjudicated, and execution is done properly. When I'm saying execution, so what is to be seen that if anywhere a company is coming into picture as a security provider or a partnership firm, then what is to be ensured that a supportive resolution as per the articles and memorandum of the company are obtained, and as per the partnership deed, authority letter is taken, and the person signing the document is duly authorized. All those things need to be very very meticulously and diligently seen, because this is something which will come into play in case of a default by the by the borrowing entity. Then all these things will kind of become suddenly the most important document. Otherwise nobody will get into it. Money is repaid, facility over, reconveyance will be done, chapter will be closed. But God forbid, if the project goes bad, then it becomes very very important there. Then if you see uh, registration with a sub registrar, so if there's a mortgage that has to be registered with a sub registrar, it's very very important. And these days, even if it's not a simple registered mortgage, even if it is a memorandum of entry for deposit of title deeds, that is required to be notified with the sub registrar. But then generally for a project loan, for a loan for a real estate project, generally we do not advise, we as lawyers never advise to go for mortgage by way of deposit of title deeds. It always has to be a registered mortgage. So the second part is so basically what I have done for my presentation, I have split it into two parts. One, project financing in real estate. So one, the first part was project financing, which was talking about what all kind of funds are available, and what all are the I mean in generally what funds are required at what stage for which kind of project. Second part, I have captured basically the real estate projects which is generally required funding. It could be residential, it could be commercial, it could be industrial, or it could be a land street, vanilla land and that may be required. So if it is a residential project, then the construction finance uh, is required, which for a residential project, if it is a commercial project, then you can have two kind of funding. One could be the construction, second could be the rental discounting, lease rental discounting for a commercial project. you know if it is a land and if it is an industrial unit, then the project funding that is required is generally at construction stage only. So now I have come to specific kind of projects that are in Maharashtra, because otherwise in other states you have project either land or land only, which could be JDA model or otherwise. In Maharashtra, you have project which will have a vacant land, you will have project which will have a slum, you will have a project which will be a redevelopment of a society. You will have a project wherein Mahada has already constructed a building and it's a Mahada building which is in old shape, which requires redevelopment, and Mahada calls for a new guy to kind of come in and develop the building. And in lieu thereof, the new guy, that is the developer, is going to get the FSI for the project, uh, for which obviously the developer need funding. So these are very very peculiar and very typical to uh, Maharashtra. These are the different schemes which are available specific to the state of Maharashtra. I will go by, in the next slide, I will talk about SRA and then MAHDA and then society redevelopment. Then we'll go on to the question which was asked in the beginning, that what is going to be the security, which is, I feel that it's very very important uh, from a funding of a real estate project, as far as real estate project funding is concerned. Now, moving on to the next slide, SRA. If you see now, SRA, we all know that this was initially it was a slum rehabilitation scheme, which was way back in 1995. It was sort of it was enacted, and then there was a concept of TDR that was introduced, and Central Monitoring and Cleaning Agency, subsequently it was set up. So all those things happened, and then you have these are the processes and benefits of SRA. If you can, you can just have a look at it, you'll understand. I need not necessarily repeat everything. uh, SRA probably has the right to denotify any area as a slum area or not. you know they they have basically any project that has to be qualified to be implemented under SRA, 70% consent was required. I think now with the new change, it's become 50%, if I'm not wrong. And then there are certain protocols, or there are certain compliances that are to be done for implementation of SRA scheme, which is annexure 2 preparation. Then certain premium has to be paid to SRA by the developer. Then the LOI that is required to be issued. So all those things need to be complied with for any project to be implemented under SRA. Now, see, from funding perspective, if I have to say, now if you see, there's a point which says that developers shall pay requisite development charge to SRA. Now, see, this is one of the process of getting approval, but then this charge is something which is very very high sometimes. So you will see a lot of there will be funding by a real estate investor for a project in SRA. And for this particular funding and for the payment of these development charges, there will be another entity that will be coming in to fund this kind of premium only against certain FSI that they may ask for as a security. So these are the different stages wherein the funding may be required by the developer. If I have to link it to the funding part, the premium which we are talking about, it's, if you see, the premium is basically directly related to the ready reckoner value of the property, which is free sale component plus premium at the rate of 25% of ASR of that particular year. There is a restriction on transfer of slum dwellers. Now moving on to the next slide, it's basically MAHDA. which governs project which is regulated under MADA. It could be society redevelopment. It could be a MADA redevelopment project. Basically, these are the two projects that are generally regulated and guided by the MADA Act. This is again a procedure that has been laid down. This is more from a developer's perspective, or probably you know as a lawyer, these are the basically procedures that has to be followed for a project that has to be developed under MAHADA scheme. It could be MAHADA society redevelopment or MAHADA self redevelopment both. Now this is society redevelopment, which also is basically governed by regulations wherein the MAHADA gives the society permission to kind of redevelop the project. Now society redevelopment, as I said, this is regulation 33(7) of new DCR 2034. That talks about. So this particular slide is basically more onto what was the available FSI, what is the permissible TDR, and what is the built up area and all those stuff is what this particular slide is dealt with. So related to 33(7) MADA redevelopment, which is society redevelopment. Now coming to the next point, the security. So the question that was, I think, asked in the beginning, that when the construction finance is given at the approval stage, where there is no construction, what is going to be the security? What will be the security? So to answer to that, is the security could be, if you see, I have mentioned that security, it could be land and building, it could be development right and sale FSI, it could be proportionate share in case of a joint DA wherein there is a area sharing understanding. So these are the securities basically that is available to any lender in the market, depending on the project. Now if a project is under SRA, if a project, if a developer is taking the project which is an SRA project, there basically security cannot be land, because land is something which cannot come to the developer as a security. There the security will be your sale FSI and the development rights. So though the construction is not there, but the future construction is already charged to the lender. That is what is going to be the security. So in case of a default, what happens, the lender can assign all those rights, which will be not only the right to construct, right to rehabilitate, but right to sell also the FSI, that is to the share of the developer. So that also gets transferred. So that is going to be the security in case of a project which is an SRA project, or in case of a project which is a society redevelopment project. There typically the security that is available to any investor, it will be the sale FSI or and the development rights. Unless and until because for obvious reason, because here in Maharashtra, it's very very peculiar that the project gets sold even before the building is in place. you know it's a sort of the flats that are under construction that get sold. So typically what is getting sold, though the nomenclature is given as that flat number X in wing so and so, but effectively it's not there. So to the extent of FSI only, that is being sold, which is what has to be given as a security as a whole. You can't so basically what happens typically, if a funding is done, then as a lender, if you have to see, then the security has to be the total FSI, because you cannot have into like some 4 5 or probably 10 flats. In that case, what will happen, however, there is no restriction as far as taking flats as security is concerned. But what will happen is basically, if you are not if the developer is unable to kind of complete the construction, then your security will remain your security only, because you can't really enforce those 10 flats. Those 10 flats will come to you only if the flat is constructed. So construction finance, as far as construction finance of an under construction project is concerned, the security that ideally should come to any lender should be the entire project, the entire FSI, so that if at all the enforcement has to be done, it can be done in totality, and you can replace the existing builder with the incoming one in totality. I think with this, I would like to stop here and thank everybody for bearing with me and listening to me. I'm happy to take any question if there's any from anybody.
Yeah, there are a couple of questions, Sadhav, which we have received on YouTube, and the first one is that how will be the tranches of money be disbursed? What will be the exit right for the lenders, and is there going to be some kind of a internal rate of return which is fixed on the funding? So I think that mechanics will be worked out entirely on a commercial
Correct.
kind
This is something
of.
which will purely, and generally the funding is not done upfront total. It is always linked to the construction. So it will be, so the funding, to my knowledge and to my understanding as a lawyer, the lender also do not give money because it is always given against construction. So generally there will be 2-3 tranches. One tranche will probably be released upfront, and then second tranche will be given only on compliance of certain condition which will be let down in the sanction letter. Once that is complied, then the second. So these are the checks and balances to ensure that at every intervals the money is being utilized properly. Though we have all those RERA and other acts to monitor that now, but
Yeah.
lender also but they also kind of put all those checks and balances at their end.
Yeah. Another question is relating to the SPV structure, which I think we have. So, like housing the project in an SPV structure,
Hmm.
uh, do the builders use that a lot? Like, probably this is
Yeah.
for ring fencing the entire project
Correct.
expenses and yeah.
Correct. So what happens, like if I'm a developer, and if I'm running 20 projects, if I'm running 20 project under my, parent company, then it becomes very difficult for me to kind of, and I'm exposing a risk also to my, parent company. I'm exposing the risk of, because, then in that case, what will happen? Anybody can take me to the court, take me to RERA, and the whole company will undergo, like, sort of, lot of unrest. So basically, to avoid all this kind of problems, what a developer does is, like, for each and every project they will float an SPV, and they will buy the project in that SPV only, and that SPV will be responsible for that particular project only, so that all the sort of money that is coming in, all the loan and borrowing, everything that goes in that SPV only, so that for them also it becomes
Cleaner.
operationally it becomes very easy for them to kind of manage, and legally also, because their parent company is always I mean, out of this all this mess. So yes, I mean, it is. I mean, 99% cases I have seen the developer coming up with SPV for each and every project. They don't do it under their parent company.
So you will find building companies usually with loads
Correct.
of different
Correct.
sister companies, or
Correct.
it will be a
Correct.
huge mammoth structure.
Correct.
And then the problem is you can't close the company down once the project is over also. You can't close it that easily.
No,
So it
probably I
gets,
think the cycle of the company will be till the time the project is. So the project suppose gets completed in 2020. If you are able to sell off all the assets that you have in the project, so effectively there is nothing left in the company, then you can close it, which is not so easy. Like, it takes about 8 to 10 years, because construction itself will take you 4 years. Then you will want to keep certain inventory with you to sell it at a a higher price once the building gets completed,
yeah,
to fetch for the better money. So yeah, I mean, the cycle is probably 7 to 8 years if everything goes on fine, if there's no delay in the project, etc.
right. Okay, I think I don't see any further questions here on Zoom or on YouTube. So I think we've covered quite a bit of, the real estate project financing on a in a quite exhaustive manner, I must say. Thank you so much, Sadam, for intermingling law and finance for us together. It was very
Uh,
interesting. and I think people enjoyed and got a lot of insights. Thank you so much. Thanks everyone for being
Thank you.
here. Bye. Have a nice evening, everyone.
Thank you.
Bye,
Thank you.
Sadhav. Thank you.
Bye. Bye. Thanks.